What's going on, everyone? Mel Stacks here, and I just want to talk about debt and kind of why I've always avoided it, never felt comfortable with debt, and how debt is, like, more so why it's not part of my financial planning at all. No mortgage, no nothing. I know it's like kind of goes against what a lot of people have told me, like all the financial advice and everything that people always say, especially here in Canada, buy a home, prices only go up. But I do like the rope around that coin, though. On that one, that is kind of nice. But for me, debt is just, it's how everyone gets wiped out eventually. You could be right on everything you're doing, but if your timing's off, like investing on margin, it's all kind of like goes against the entire point of why you're investing in the first place. At least for me. For me, it's all about financial peace. Like, that's my goal. I know a lot of people want to be as wealthy as possible, they want to just see the number as high as possible. For me, it's really about financial peace. I know that's kind of a Dave Ramsey line, and I do like it, even though I don't invest at all how he recommends to his audience. For me, I kind of see like 12%, that's kind of like that's what he's kind of hoping to get every year in the markets, like annualized rate of return. I don't understand why I would make that my goal if I'm exceeding that. I'm not Warren Buffett or anything like that, but I might, or so far, I might be beating that 20% since I've started investing, but I also feel like he would be consistently getting 50% a year if he were investing. Where it's, that's also partly why you don't want to go into debt to get a house and everything. You'd have a lot less money to invest in overall. Like, you think about it, if your housing in Canada is so expensive, we have so much land, yet we've driven, like, it seems like on purpose the price of housing to go way up. But I just don't understand the point if of going into debt to get an asset that's at like historically massively overvalued. To me, that makes no sense. To me, it's why take the risk? Who knows what's going to go on? We have people now who are struggling to get mortgages renewed because there's a credit crunch, and like when credit tightens, you don't, you're kind of counting, like going into debt and relying on debt in order to stay afloat, because you kind of, when you have to renew your mortgage every 5 years, you know what I mean? You're, it just doesn't, you don't know what's going to go on in 5 years time from now. I also feel like the rate of returns is going to be higher in the stock market. Like, just having liquidity, being able to take advantage of opportunities that come up, that is kind of how I found success. Most of the time, investing is as boring as can be. But that 5% of the time that it's exciting, I'm not that steady investor. Always be buying, always like dollar cost average. That's not my approach to the markets. It's not buy the S&P or anything like that. The logic of that really goes against what I'm saying. The logic of going, like, it doesn't make sense to me to buy companies that you don't analyze and buy as many companies as possible because they can't all go bankrupt at the same time. To me, that just doesn't make any sense at all. Like, there's a time and a place for ETFs. when you can't identify where the best opportunity is, but you know this sector, this country will do better. I get it, but that's not a buy and hold forever thing. That's a short term to mid-term kind of like a swing trade kind of thing. Which to me, that's kind of a gamble. I'll do it every once in a while, but that's not my foundation of my portfolio. That's not really how I invest. Sometimes things seem very obvious to me and I'll take advantage. Silver, when that was rising, I didn't buy physical silver. Premiums are crazy. You don't know how high it's going to rise, but you know the hype ain't over. You know what I mean? Now, luckily, I've sold it pretty much at the peak. Not quite perfect timing or anything, not that that's going to be a thing. But I sold it pretty close to the peak, before the big crash and everything. So, I sold it all at the time. SILJ. Junior Mining ETF. That was kind of a swing trade play I did. Not that I recommend doing that. I did that with a very small percentage of my portfolio, like less than 1%. So overall, did I make a big gain? No. But it's the small, consistent wins that is all I care about. It really does add up. And that's kind of the thing. You have cash on the sidelines, you're not constantly investing, you're not constantly doing the same thing. It's just you're not going into debt to buy assets like that. Like, especially when I see what's going on with mortgages today. People who've never missed a payment, people who the amount they're owing is going down. On paper, it's much more logical to give them the loan now than when you have in the past. And they can't get loans. You're putting yourself at someone else's mercy. And to me, that is like, why? You could be 100% correct in everything you think. You could be up massively on the house that you purchased however many years ago. But now you can't renew, so you're a forced seller. You have to add inventory to the marketplace that's already declining in price. You know what I mean? It's not a really good equation. So that is just kind of like, the markets could be irrational longer than you can stay solvent. That's a very common saying. The whole point is, don't go into debt. Don't take on margin. Don't be that person that does the whole margin investing. For me, it's financial suicide. Some people could, like, the math might make perfect sense. But to me, it's just, are you really going to have peace of mind and financial peace? That's my personal goal. It's not to be a billionaire. Personally, I've got my number where if my net worth were a certain amount, I would still keep making money. But that's money to, like, I'm working for others at that point. I'm not working for generational wealth that'll last generations and everything, because at the end of the day, if they don't understand money, the future generations of my family and everything, my money ain't gonna help them. That's kind of what it all boils down to. My son, he gets it. He's doing quite well investing. And he started at a very young age. So, to me, that's the next generation. They get it. There's a good point to this. And when you understand money, you don't need a lot in order to have that snowball effect really start taking off. I feel like for most people, you save $100,000. You do start at 20. You do that when you could if you could do that by the time you're 30. That's your retirement right there. You don't need to be getting crazy high rates of returns. You know what I mean? You could get, like, if you get that 12% that Dave Ramsey shoots for, you're going to be pretty good in retirement. There's no point of worrying anymore. That's one big load off your mind. Having that time to let things compound is really the main thing. You could start if you start investing as a teenager when you're 20, you could save up a decent amount by the age of 25. And you'll probably never actually need to save another penny by retirement if you do the math. The power of compounding is actually kind of crazy. And you have a couple good years. You do a bit better than you anticipate, and it's amazing how that snowball can run. When you're when you're in debt and you can't start investing, so you got to pay off that debt. When you have credit card debt, like, there's very few people on this planet that will be able to beat a credit card interest rate with their investments. Some people can, but they don't. You're limited to a certain point. Once you have too much money, there's a lot of opportunity that leaves in the marketplace, which is why I think that Warren Buffett would be getting much higher than 20% a year if he was like you or me in terms of wealth. Because here's the thing that a lot of people don't take advantage of. They buy the big blue chip companies. They don't pay attention to the balance sheet. They buy the S&P 500, like literally the biggest companies around. I started off doing things like that, waiting to see value in those big companies. And it makes a lot of sense as to why you see guys like Warren Buffett, other big funds doing that, because they have so much money. They are limited to big companies, otherwise they're really going to move the share price. And there's no point of spending the time and research because you can only invest so little percentage of your portfolio into it. Why even think about it? So if you could find value in smaller companies, you could have your own comfortable limit on how small. Personally, I stay above like $1 billion in market cap. That's where I'm comfortable, but do I need to be buying trillion-dollar companies, the biggest companies on the market? No. I love my small shipping companies that I own, my Torm. That's one of my favorite companies that I've owned. Pays me a crazy high dividend. It's done phenomenal lately. And to me, it's oil shipping. A lot of people get nervous. But the cost of shipping oil has gone up. They're going to make more money. They have no ships that are caught up in the Strait of Hormuz. They're going to be fine. For me, it's just, can a guy like Warren Buffett invest in that, though? Absolutely not. He's going to move the share price way too much. The market cap isn't big enough for him to spend the time and effort investing in it. To me, it's just embrace your position in life, who you are. I'm a small fish in this sea. I don't move the markets when I buy and sell. I'm embracing that. I'm able to buy companies that are a lot smaller than, like in market cap, than the big fish in the sea. The Warren Buffetts, the Bill Ackmans, the Paul Tudor Joneses. They have to buy big companies because of the size of their funds. To me, it's kind of more of a blessing to be a small fish in the sea. It's more fun. There's a lot more opportunity you could take advantage of. Do I want to buy companies that are worth $50 million market? No. Absolutely not. That's too small. But do I want to be able to take advantage where the big fish can't swim, sort of? Absolutely. To me, that's where the money's to be made. I'm not really worried about missing out on the Nvidias and stuff like that. I've found a lot more, like that company Torm shipping company I've mentioned. I love what it's been doing. I bought it because I thought it was a nice solid company. I like the dividend, but wow, it's really gone up lately. Where I'll have diversification in my portfolio, but I'll be in different sectors. But I'll try to only buy what is the best value for those sectors that I could find. I'm not gonna buy in like right now. I don't own ETFs. I don't own any funds, any holdings companies right now. Nothing of that nature. It's all single stocks. Do I own some big companies? Yeah. JP Morgan. That's one of my favorite companies that I own. I think Jamie Dimon is a genius when it comes to the markets and understanding money. A lot of people hate him, mainly because he was profiting massively during the 2008 financial crisis. But that's because he wasn't having a bunch of failing loans, because he wasn't doing like any ninja loans and stuff like that. They were staying away from that. To me, it's pretty smart, actually. It's why would I be worried about, like, to me, it's kind of a good thing that they're able to be profitable in that time. Why would I be complaining about it? Why not enjoy it? But that's just my personal opinion. And thanks for watching. Stay positive. See you next time. Thanks. Bye.